So with us right now, Jonathan Sheridan. He's with FIG Securities and he joins us live from their camera. Jonathan Sheridan, you're kind of listening to all of that, seeing bits and pieces yourselves. What's standing out in terms of themes for investors at the moment out of all of that data?
Yeah, good morning, Brooke. Thanks for that. I think the theme is mixed data again. You know, we've had positives on one hand, which being the Chinese CPI data, which is showing that their more accommodative settings that they had over the last couple of months are feeding through into real numbers. And then we've had, you know, the lower housing finance numbers, although that's been offset by the investment housing. So I think it just goes to the main trend that we've been seeing over the last year or so of investors searching for yield. You know, they're looking, people are rolling out of term deposits, let's say in their self-managed super in particular, and they're looking to get some yield better than they can in a term deposit right now. And property investment is obviously one of those places that they're looking, hence the strong investment read. I think for the general economy, having the pickup in China is good, but it's a nuanced thing. Obviously, the central bank controls things very tightly there, and they'll be monitoring that, so they don't want to go too far too fast. So the slight improvement over expectations is obviously good.
Where do you think investors draw their confidence from or kind of take cues from? As you said, mixed reads across the economy. Businesses fairly resilient, yet consumer confidence drops off a cliff. Where do investors sit?
I think investors sit on the sidelines right now, to be honest. I think the consistency being shown from the central bank, from Glenn Stevens and his colleagues, is comforting for investors. Despite that, they're still searching for yield, as I said. You know, global yields are contracting mainly due to contraction in credit spreads. So that's the reward you get for taking risk in, say, a corporate bond over a government bond, for example. So those spreads have been contracting a lot over the last 12 months, and that's why yields have come down in general. So, you know, banks know that in particular, they don't have to compete so hard for term deposits at the moment because the world's an uncertain place. But we've got this mixed data coming out all over the place. So term deposits rates are falling, and therefore investors are searching for yield, which is pushing up the asset classes which give it, such as property.
Just comments about kind of risk and return. You reminded me of some of the comments that have come from Glenn Stevens over the weekend. We might get back to some data, but Glenn Stevens over the weekend talking about, I guess, the risk equation, saying regulators should not try to stamp out risk entirely, and kind of going further saying, yes, we've had all this kind of phase of regulation, but we actually need to deal with that, move on and start looking at the risks ahead now, not continually try to finesse all of this regulation that's come post-GFC. What did you think of all the comments that he was making about risk and regulation?
I think it's interesting. It marks a bit of a shift in the RBA's language. They had the financial stability talk last week, talking about the fact that it wasn't the role of the Reserve Bank to basically just regulate all markets and make sure that they're stable. I think that risk is a part of investing, and that's why you get paid a return. So as an investor, you need to be aware of the risks you're taking and ask yourself if the return is commensurate to the risk you're taking. I think that's part of what's difficult about investing in these markets, because we've seen that the QE program, for example, has pushed yields down on all sorts of investments as equity markets have risen and bond markets have risen as well. So I think it's always a decision for the investor. I don't think that's changed. I just think that the opportunities for value, which is obviously where you get the best returns, are limited now, because there's a lot of funds searching out those limited value opportunities.
Just back to the data, Jonathan, before we lose you as well. Are you seeing bond markets reacting much to this local data that we've had recently? Obviously noting the Australian dollar's been kind of pushed around quite a bit recently because of it.
Look, what we've seen in bond markets over the last week or so was a fairly sharp rally anticipating the ECB decision last week, and then we've had a bit of a correction, if you like. Yields probably came in about 10 to 15 points and then moved out about 10 to 15 points. So it was a case of, you know, yep, okay, we've seen what's happened, that's what we expected, things have tightened in, but now we're getting back to the business of just trying to find some yield somewhere. So I think markets are flat on these numbers that have just come out. I don't think that these sort of sentiment numbers really move bond markets too much. You need hard data. So I don't see that bond markets will move too much on these numbers.
Fantastic. Thank you so much. Great to speak to you today, Jonathan.
Thanks, Brooke.
That's Jonathan Sheridan there from FIG Securities in Sydney. So